April was a month not short of talking points. In the equity market, most of the major markets are still struggling to stay above water on a year-to-date basis. Europe was the strongest performer on the month as the domestic growth fundamentals of Europe provided some support in the face of a fairly volatile global environment. As we speak, earnings season for Q1 is underway, and as expected, the US tax cuts have had a very visible and positive effect on earnings to the tune of around 8% on a year-on-year growth basis. We expect this effect to last for a few more quarters before it fades beginning of next year. Another major talking point was the US 10-year yield on Treasuries, which popped across the 3% level. This looks to be much more important for market sentiment rather than anything else. It is in line with another call that we've made at the beginning of the year, namely that interest rates will rise gradually but steadily throughout 2018. That review still remains in place. Inflation concerns in the US have resurfaced, but the evidence in hand suggests a level of inflation consistent with mildly higher yields but no blowout. Equity markets are clearly nervous about the implications, but we reiterate the move upwards in both rates and inflation are normalizing events and not the crystallization of a major event risk. Given the higher level of rates, the call to be defensive on duration is working out well, and we stick to this call for the foreseeable future. The credit backdrop is still good despite some market-specific events in, for example, Russia dominating news flow. From the point of view of overall allocation, we again emphasize our overall call to be overweight of European equities. We are underweight of Japanese equities. The portfolio also has a mild overweight in cash, but a very strong overweight call in hedge funds. They will continue to provide a buffer against the volatility of the broader market for at least some time to come.